Mr. Market is valuing Dow Jones at above 7,000 and S&P at above 800. By your valuation model, at the current interest rate and current inflation rate and current growth rate, what is the fair valuation of both these companies?
Yeah. Well, that's a good question, but a tough question. But I would say that if you believed the American business in aggregate could earn the kind of returns on equity that they have been earning in the last, or it has in the last couple of years, and then you postulate no change in interest rates, you can justify 7,000 on the Dow and 800 on the S&P. Now, there's a couple ifs I threw in there, and if interest rates go higher, the valuation goes down automatically. And more importantly, if the returns on equity of American industry, which are at historic highs, and which sort of classical economics would tell you would be hard to maintain, if those returns go down on average, that also would pull it down. But if you're willing to accept the current level of returns on equity as being typical of the future case for American business, and you're willing to assume present interest rates are lower, then you can justify a valuation on the Dow and S&P. And it's interesting, because I got all that commentary after I wrote that line in the report, which was, as I said earlier, designed for a little something else. I'll give you a little trivia quiz. What 2 years in this century has the Dow had the greatest overall gain? The 2 years in the 1900s are 1933, which most of you don't think of as a banner year, but and 1954. And in both of those years, the Dow was up over 50%, counting dividends. In March of 1955, because of that, the fact that the Dow had gone up, bear in mind that the high on the Dow was 381 in 1929, and it took 25 years before that was surpassed. And in 1954, the Dow went from, say, 280 up to 404 or something like that, just a little over 50%. So what did they decide to do? They decided to have congressional hearings about it. And they did. In March of 1955, they had hearings in the Senate Banking and Currency Committee, Chairman Fulbright, and my boss, Ben Graham, was called down to testify. And it's fascinating reading. Bernard Baruch was there, all kinds of people. I've got the hearings at home. And Ben's opening comments about the market at that time were the market looks high, it is high, but it's not as high as it looks. Well, that's about the present situation. I mean, it looks very high just by comparing 7,000, certainly to the 404 at the end of 1954 when Ben was testifying. But there have been huge changes in earnings and return on equity on American business in general, and then you've had this big move in interest rates. Now, those are underlying fundamentals that have powered a huge bull market. After a while, as I mentioned earlier, people get captivated simply by the notion of rising prices without going back to the underlying rationale, and that's when you get very dangerous conditions in terms of possible bubbles. And it would, I have no idea where markets will go, but you have the kind of conditions that could cause real excesses, just like you had excesses in 1973 and 4. Going back to when you could buy things at 20 cents on the dollar, you had excesses in the other direction. The country didn't disappear or anything. It's just people behave in extreme ways in markets. And over time, that's very good for people that keep their heads. Charlie?
I've got nothing to add.
Okay, get one more.